Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to the Options Insider's exclusive coverage of the 2009 Options Industry Conference. Coming up next, we have the perennial crowd favorite Exchange Leaders Panel. This panel features all of the heads of the major U.S. options exchanges and exchange groups. The panelists include Ed Boyle of NYSE Euronext, Will Easley of the Boston Options Exchange, Edward Joyce of the CBOE, Gary Katz of the ISE, and Adam Nunes of NASDAQ OMX. The panel is moderated by John Lothian. If you'd like to hear more from these panelists, then stay tuned to Options Insider Radio. You've already heard our episode with Ed Boyle from NYSE Euronext, and we have more episodes on the way with the heads of the other major options exchanges. So thanks again for listening, and stay tuned to theoptionsinsider.com for more exclusive coverage of the 2009 Options Industry Conference.
I'd like to welcome our leaders up to the platform here, please. They were right. You can't see anything up here. So all of you back there that are giving us finger signs, don't worry about it. So I'm very pleased to be here today to moderate this panel. As you can see, we do have some significant changes from the panels in the past. Evidently, if you win the Sullivan Award, you're exempt from having to come up here.
For 1 year.
For 1 year? Okay. That's what Sandy Fruker told me that I should say about Bill, that, he's too good now to be on this panel.
Bill didn't want to come up here because Sandy's not here to pick on.
Yeah, exactly. And the other thing is that we have fewer people up here overall, it seems like. We have this whole consolidation thing that has happened. And so, I don't know, Adam, or Ed, you guys kind of have to have split personalities here a little bit to represent everybody that you're supposed to be here.
Yeah, sometimes I'm afraid that when I wake up in the morning that I might have to call the regulators just to make a decision. That it can get difficult sometimes, but it's definitely an interesting direction that we've taken the markets, and being able to run a dual market structure and pricing structure, I think, is a big benefit to the client base.
Well, the last time I moderated the Exchange Leader Panel, it was at the Security Traders Association conference in Chicago in January 2008. And that's actually the day that we launched Markets Wiki, small plug. But one of the questions that I asked Bill Brodsky at the time was, hey, we got NASDAQ, which is buying starting two exchanges, or buying one and starting one, and we got NYSE with two. It seems to be that two, is kind of the trend. And so now we've got CBOE that's starting C2. I thought that C4 actually would have been a better name for the explosive growth that you should be expecting. But Ed, what's with that? How are you going to compete with that?
Well, we really felt left out, having only one exchange, and we thought this was the most direct way to get at it. So we're developing a second exchange, and we're in the evaluation stages, talking to our customers as to what is the most effective market model. And it appears that the industry is going in the direction that there will be subsets of business directed to different market models, and we want to cover the landscape utilizing that second exchange license sometime in the third or fourth quarter of this year.
And if you've looked at the Form 1, you figure out how you get around not having the market model but still filing. You just file for every conceivable market. Yeah. So you've got price time, you've got market turn or pro rata, they're all in there. They can all get approved.
Just check the box.
Yeah.
So does the SEC have a 2-for-1 special when you fill out the form that you can?
Absolutely. Jump in, the water's warm.
Well, we know what the market model is that we would like to have. We're having trouble with the name. We thought of I2, but our English teachers all said that that's not grammatically correct. So we changed it to Me Too. But our board of directors thought that meant that they would not be part of the rule filing process because we'd be doing Me Too filings all the time. So we're thinking of us too. So we're still working on it.
Where do you take that one?
Anything else?
Thanks for bringing it up.
Yeah. So, how many pieces of this pie are there? I mean, we're talking about kind of fragmenting the market in so many different market models. As I was sitting in the back, I'm hearing about a new exchange in Miami that has been talked about. And I don't even know what model they're going to bring to this. But how many different combinations are there that really have value? I don't know. Will, what do you think?
Because we were, until NOM came in, we had been the newest one for a while. And I remember at the time when we were starting, and it was, there's not room for 6. And so we kind of looked around and said, well, who's leaving? And because we were coming. But when journalists ask the question, it depends. I think there's 2 ways of looking at it. If you look at it in terms of economically sustainable, we think there's probably, if the pie were distributed evenly and everybody had very low costs, there's probably room for 20 or 22 exchanges, if you look at it that way. Obviously, there's not probably 22 variations on market models and service propositions for it to be useful. But what I think is important is just the door is open. Everybody can get into OCC. Everybody can get into Oprah. And the competition will provide the customer with a lot of choice. And that's good.
Yeah, and I think if I guess to some extent it is up to us in as much as, Ed and I want to think about number 3 and these guys want to think about number 2. But it's really up to, people out there who think they have something new to bring to the market, who can either, bring a unique market structure, bring a process efficiency, but it's up to, if these guys want to bring a new exchange, we're not the Council of Elders who gets to say no. That would be nice, but, it's up to them. If they decide they have something that's going to work, they can do it.
Well, there was a day when I thought 1 was enough.
Actually, I still do.
But then as that evolution has gone on, I agree that there's room for more, but I don't think it's endless. If you were in this segment, in this room for a couple of breakout sessions, you'd see that there's a growing concern of the costs associated with tying into multiple exchanges. And while the current rules don't provide for pure fragmentation of the business because of the NBBO and the smart routers are doing a fairly good job, there still is overhead associated with tying in, and the trading firms evaluate that in taking each of the steps that they do. So I think we have to be sure that we provide something new, as you brought up, and there is a point where there probably is diminishing returns.
Has the financial crisis at all and the fallout of the way that some of the investment banks have diminished or disappeared, has that influenced the fragmentation at all? Has certain types of trade moved to certain models, or has it changed plans at all for how you want to attack?
I think one of the things, and it gets to Ed's point, is when I look at launching NOM and going out to the market participants and convincing them to connect, I look at the timing, and I can't imagine if I was doing it 6 months or a year later, where technology resources were so much tighter and the value proposition had to be so much greater to get people to want to dedicate the time and effort and dollars to getting it done. So I think that's one area that if you look at expansion, it's going to be a challenge, unless you can really bring something good to the market.
Okay. So who wants to jump into a dark pool? You know, I had a friend in Indiana, and they had a pool at his aunt's house, and quite frankly, you could see in the shallow end, in the deep end, you really couldn't, and then in the shallow end, all of a sudden, we saw this snake that had taken root in the pool. You know, so sometimes when you can't see things in the marketplace, it's a problem. It can be adding to the liquidity, certainly, but there are also some problems with that. Ed, what do you think?
Transparency in the options business today is there are really no dark pools today that exist, and it's simply got to do with we've still got the inability to print trades to a TRF. There's no TRF functionality. It's not like the equity business. It goes back to your point too with how many exchanges can survive. In the equity markets, with all the multiple trading arenas out there, all the dark pools, I don't even know how many are there, probably in the mid-20s of what act as exchanges. But in the options business, you can't do that. And that's one of the transparency is one of the hallmarks of the options business and one of the pieces that has helped it grow so well. I mean, Bill brought it up in his speech, that's one of our the big wins for the option business is the transparency. So dark pools I don't think should exist in options. We're starting to see some of that break now with some of the order types are out there, some of the crossing mechanisms that there is nearly 100% internalization in the option business. If that starts to proliferate, we'll end up with dark pools. And as we go down that path, which I think is probably being built upstairs today, I think we could see very poor quotes on the screen, reduced liquidity on the screen, and it's a very slippery slope for us to take, and I think it's a mistake.
Isn't the OTC market just kind of like one giant dark pool in some ways?
And we saw what happened to it in the recent credit crisis too, in a lot of ways, right?
Yeah.
So that's that points to what's going on with it. And to your point earlier, I think that we are heading down where some of that OTC trading is starting to make its way into the listed market. We'd like to see a lot more of it. There's a lot of cost concerns there. There's a lot of functionality concerns, and the way that they do like to hide the identity of many of those orders. So if we can solve a lot of those problems in the options business or the listed options business, then we'll be able to attract that business.
Yeah, I think the way I look at it is, there's a clear preference for transparent liquidity. However, if you force that, what happens is some of the liquidity pulls off the market, and it becomes latent, sitting on a trading desk. So the way we view it is transparent liquidity, is best. Having dark liquidity in a centralized facility where it's accessible is better than having it spread out and latent, sitting at trading desks waiting to come out.
So we don't have this dark pool, but yet we see a tremendous amount of influence, potential synergies, all different kinds of things coming in because of some of these deals that we have with NYSE Euronext and with NASDAQ, OMX, the securities and the options together and what ISE has done with Eurex and everything. Are we going to see more influence from the securities world in some of these things into the options world? I mean, is it just going to bleed over because of these deals?
Well, there have been many influences, and if history would be an indicator, whether it be the pennies or the payment for order flow or the algo traders, it all seemed to move from stock to options. But I believe they really are different. And when you speak of dark pools, I think the options market is different, and we can do serious damage to our business if we facilitate the crossing of order flow without exposure. Exposure has been critical to this point in the development of the business. And the stock side is different. It's easier to find and match a buyer and a seller. In the options, there's so many different series, and that people are using, the liquidity provider are using the ARB function to provide liquidity and accommodate orders in all different kinds of series and shapes. And I think that's particularly true in periods of market stress. So while there is plenty of room for people that are show desks that are pairing orders and exposing them and then printing them, I believe that the exposure rules that are in place are critical for us to provide the liquidity that's needed in our business.
Maybe I can give an example out of the Eurex model that would help demonstrate the difference between the U.S. market and the European market, and they really are very different. We continue to talk about the U.S. options market as an industry that was primarily retail and is slowly but surely bringing in the institutional business and changing over time. But it is still not an institutional-driven business. There's a great deal of retail volume in the U.S. When you move into Europe and you look at who is trading these products, it is not a retail segment. That is not a focus of that business. It's an institutional market, and they have tried to balance an order book from an exchange perspective with block trading, theoretically an internalization mechanism and a printing facility. The order book in that market has never developed. It does not thrive because it is very difficult to make a two-sided market, for the market makers that are in this audience, to make a two-sided market on the screen when trades are being done off the market and then just being printed on the market. Typically, when a market maker in that environment trades, it's because they were just run over by an order. If you want continuous two-sided markets in every series that is being offered by an exchange, you cannot separate those two. What is developed in the U.S. is a continuous market for everybody to trade on, both retail and institutional. The fastest way to empty those screens of quotes would be to allow the internalization and the dark pools and the matching to take place off exchange.
I couldn't agree more with that our quotes are one of the greatest forms of advertising that we have, and our customers are very intelligent, and if we damage the face of the book, we'll damage our business for a long time to come.
Isn't that where we're going today, though, with a lot of the order types that are out there? And I agree with you. We're heading down that road towards what happened in Europe, where suddenly everything went upstairs. It turned into an IDB market completely. But today, the direction we're taking with some of and I said there's no dark pools, but there is dark liquidity out there in the dark penny series and in some of these order types that are out there today, the all or none, fill or kill cross, things like that. Doesn't that destroy the liquidity out there? Isn't that what we're faced with today? That's what I see as the scary part of it today.
I think there is a balance that we have to achieve that provides the services that the menu of customers want without eliminating the incentive for the market maker to make a market. And it is a tricky balance for us to achieve.
So, Will, I left my scorecard at home. Who actually owns Box now?
I do.
That was easy.
We are 53% owned by the Montreal Exchange, which is in turn a 100% owned division of the Toronto Exchange.
And who owns them?
It's a publicly held company.
Publicly owned. So it's not Box owns TMX so that it's a big circle? Or
No. We have no shares in TMX.
Okay. So, so Gary's got a linkage thing where he's going across the Atlantic. You just need to kind of go, across a lake or something like that?
It's called the 49th parallel, yeah.
49th parallel, okay. Can we expect to see some synergies between what you guys have up north and what you have here, or?
Actually, probably less, because the Canadian market is already so integrated into the U.S. market. Those tubes are all in place. It's difficult to imagine how much how much value added we could add. We looked at that a couple of years ago because Montreal was already a third of Box in the beginning. And the fact of the matter is all the big brokers and banks in Canada already had relationships in place to send order flow to the U.S. market. We also discovered that they were very attached to payment for order flow, which we didn't pay, so we didn't get very far anyway.
Okay. So Adam, you guys got any plans for any links between all your various enterprises?
I think there's a broader issue just outside. Like, technology linkages are easy. Like, we already have them between our offices in New York and Stockholm and London. It's really the regulatory landscape and the ability to have customers abroad. And the SEC has approached that with the mutual recognition process that they're going through. But we haven't really seen we haven't really seen that come to fruition.
And Gary, you guys are gearing up for this linkage, and how's that going to work? Is this going to open up Germany to U.S. stocks, and is this going to give you a key advantage? And no infomercial, but please, give us what you think.
I'll try to keep the advertisement short. First, the linkage is in options, not in stocks.
Right.
And the idea is to open up a pathway for clearing members of Eurex to be able to send orders through Eurex clearing. We'll have a relationship with the Options Clearing Corporation and funnel those orders into the U.S. options market, which hopefully will increase the size of the pie for all of the exchanges that are up here. It is not just focused on Germany, it's focused on Europe, Asia, the Middle East, all of the broker-dealers that are outside of the U.S. that today either do not have the infrastructure in place to route orders through a U.S.-registered broker-dealer or are not interested in having a relationship with the U.S. broker-dealer or setting one up where they would become regulated by the SEC. This would allow them to be regulated by BaFin and come through Eurex clearing and route those orders into the U.S. market. What Adam raised is a very important point. This is a one-way linkage at the moment. It's order flow coming in from outside the United States into the ISE order book. The SEC is not yet ready to allow order flow to come from the U.S. out into exchanges internationally. That's something that we hope will come in the future, but we understand that the SEC is dealing with some other issues that have taken a higher priority at the agency.
What I didn't mention was that rather than via an ownership connection, recently there was a deal signed, and the trading system we use, SOLA, that was built for us, will be implemented in London and Milano for derivatives markets in those places. And so once that infrastructure is in place, we would be exploring the possibility of making it easy for brokers and banks connected to the trading system in Italy or London to route orders into the U.S. market via our technology. It would look very similar to what I think Eurex and ISE are doing. But it's good for everybody, not just Box.
Yeah.
To Gary's point earlier, that this is this is an all boats will rise type of situation. If we can just get the flow comes one way, but if we could get the regulatory structure that we're recognized both in the U.S. and overseas to come together, it'll create global markets that will be much more functional across all platforms. And to that point, we're at NYSE building what we call a universal trading platform, which will give all of the NYSE markets from Asia, Eastern Europe, the Middle East, all connectivity through single point gateways into the U.S. and into those markets, which will be again, all boats can rise. That brings the flow across all global markets and allows for single point connectivity, which I think is going to be a big plus for everybody.
I would agree with that. We estimate at CBOE that 15 to 20% of our business is currently international. So there is an appetite out there for our business. And the difficult part will be coordinating the regulatory structure.
If you guys are just going to agree with each other, I'm going to start asking harder questions, okay? So
I was going to offer that if you would like some order flow to come in from outside the U.S. into the S&P 500 index, that we'd be happy to facilitate that.
Thanks for the offer, but we have plenty. Thank you.
You don't really. You just think you do.
I come from the future side in terms of being a practitioner of the markets, and some of the algorithmic traders that I talked to saw a lot of opportunity, but also a lot of problems with the financial crisis in terms of changes in market dynamics and liquidity and wider spreads, or outside participation as the hedge funds deleveraged, as the investment banks stepped back, and all of that. So what impact has the financial crisis had on algorithmic traders within the option space, and what does that mean for the future growth of the business as we've seen the impact from the financial crisis on the deleveraging and the hedge fund and investment bank impact? Anybody?
I'll take a shot at it. I think initially it certainly had an impact. We've certainly lost volume from it. There's certainly been, whether it's the credit crisis or the amount of cash that's just not there in the industry. So it's had an impact on it. But from the algorithm side, I believe that that's actually been one of the stronger sides because they work well in catastrophic markets. The algorithms can come in and find the right trades. They can add alpha when they need to. And the sophisticated ability for options to be able to use to hedge portfolios or things like that has helped the options business. While our volumes are down, they're not down as dramatically as they are in other areas, and I think that we're going to see continued growth. I think the options business is still in a juvenile state. I think we've got a lot of growth left for it.
Yeah. I think the most direct impact was on the regulatory side with some of the short sale changes that went in and the short period of time to respond to those. But I think if you look at it more broadly, options market makers are algorithmic. They're not punching keys to put up a gazillion quotes a day. So I think one of the things that we saw was we had tight quoted spreads. Given the turmoil and the volatility we saw in the market, there were prices on the screen that were good prices. Spreads widened out, particularly dramatically during the short sale ban, but for the most part, we had good liquid markets on the screen that investors could interact with. So, I think that, like Ed said, they were affected, but we had a solid market going through that.
This whole short selling thing, is it just like mismarketing on the part of the industry? Should we just call it like reverse buying or negative order flow impact or something? Just kind of rebranding it.
I believe it is. I believe it has become more of an emotional issue that's driven by the media and politics than it is a factual issue or an economic issue dealing with what occurs.
You're blaming me?
I think that you could have done a much better job at marketing it. No.
Markets
No, there are people that, there's plenty of people that believe that if that rule is put back in place, that markets will have a much more difficult time going down. That would be an easy concept to sell to people that have just gone through the past year and seen their portfolios damaged. So it's not difficult to understand how it developed as a popular issue, but we have a real challenge in front of us educating the decision makers, especially on the congressional side, as to what the reality of the situation is.
Yeah, it's much easier to feel the impact of your portfolio going down 40% than it is to feel the impact of degraded market quality and degraded price discovery. And, it frustrates me when it's like, it's not going to do any harm. Like, you know what? When we did the test and we had 1,000 names in, the studies that were done on that, showed that it did harm. It showed that the market was less efficient. It showed that it impeded price discovery. And it seems like, people are kind of willing to throw those out and say, that doesn't apply now. I would venture that it still applies, that, when you look at the inability to short, particularly in the options market, it's going to affect spreads. It's going to affect, the market quality. And, it's harder for investors to feel the pain of having to pay a wider spread than just looking at, my portfolio went down. It's not going to stop portfolios from going down. We saw that during the short sale ban.
If you read between the lines of Elizabeth King's keynote address, this is not about whether it actually impacts the market. This is an emotional reaction that the population is having to the market falling. In one of the comments that Elizabeth made, she said in the last few months there's been a rally because the naked short selling has decreased. I know that the SEC doesn't actually believe that. The SEC believes in the studies that were done. At the same time, the constituencies of the congressmen and senators in Washington are all yelling and screaming that their portfolios are half the value that they were beforehand, and there's this horrible term that's been used, naked short selling. It sounds scary even if you do understand it. And it's having an impact on everything that we do. I think it is very important that everybody in this room comment on the SEC's proposal and come out in force and not just sit back and wait for this to be resolved in Washington. It will not be resolved if we don't participate in the dialogue and in the debate, and we need all of you to participate in that.
This is one of those futures versus option thing that I kind of get lost in because, when we sell futures, we just sell futures. And so as a broker, when I talk about, naked short selling, it's the customer at home working on his PC that I don't really want to see on his camera.
That's kind of like options, but...
How did he get picked to be the moderator?
There was a vote.
There was a vote, yeah. All right, so I started this thing in January or August of 2007. We launched it in January 2008 called Markets Wiki. One of the issues that we were addressing was the advent of multi-asset class trading because you guys bought Euronext and you guys did the deal with with the Eurex, and you guys did deal with OMX, and there's all these international deals going on, and futures and securities and options are coming together, and now we got talk about merging regulators again and all that kind of stuff. But what is multi-asset class trading going to look like? You guys have this universal trading platform, universal soldier, I don't know, what is it?
Well, to start, what we'd like to see it look like is where you, in fact, had a platform that all asset classes could trade and trade across borders without restriction. Now, obviously, that can't happen, and we do have the regulatory issues, and we've got the funding issues, you've got the FX issue you've got to deal with, so there's a lot there. So the universal trading platform is first and foremost connectivity and matching engine technology. That's what it is. That's what it's going to begin, because that's the foundation you need to build on in order to get to that next level. The next level, which we are in fact doing now, and others are as well, is working with the regulators, working with the clearing organizations, working with the banking structure to figure out the next move on how we get that cross-border recognition of things like funding and regulatory responsibility.
So when you packed for this trip, did they tell you we were going back to San Antonio? Is that why you have the cowboy boots on?
I brought the boots. I got those in San Antonio.
You got those in San Antonio?
Yeah.
Okay, so those are your OIC boots?
Right, I wear them every year at this conference, and that's it.
Yeah. Okay.
They kind of match your shoes, too, by the way.
Yeah. They just showed a picture of your boots. Yes. What's multi-asset class trading going to look at the other exchanges?
Well, we don't do it. We just trade options. I understand the arguments for it. I also remember back in the 70s that United Airlines owned Westin Hotels and Hertz Rent-A-Car, and it made sense because it was all travel, but it didn't work. So it can work, or I don't think you have to do it to be successful. I don't think it's a given that it works either. I think you have to, the problem you still have when you do multi-assets is you still have to be the best in each of the assets, I think, to get the business. Otherwise, people will pick and choose, as they always have, to find what's best for them in each segment. So I think it can work by doing it that way. I think you can also do very well not doing it and focusing on one thing.
Yeah, I don't think our story is dramatically different from Ed's. We really just look at it as leveraging our technology and gaining scale in that technology, which can lower the cost, of trading per unit. So we are in the process of really taking the technology we acquired when we acquired INET and leveraging that across assets and time zones. So within the U.S., we have our equity system on it. We have the NASDAQ options market. We are moving the PhilX XL system to what we're calling XL2 over the summer, and that's going to be on the same technology platform. It's not all in the same matching engine. We have different market structures, but using the same hardware, using the same code base allows us a great deal of leverage internally, and we think allows us to save a great deal of money.
Do I get a discount because I'm a 2XL tall if I trade on the XL2?
No, I think you have to pay more.
You pay more?
If that's the case.
At CBOE, we look at it that CBOE Direct was built to be flexible and accommodate the various asset classes. Sort of look at it from the product side, that the products are overlapping. So we have products on the future side, and the options and stocks interact, so we have the stock side. I do agree that it's going to take some time for the whole transition to occur and them all to trade together and simultaneously, but the technology is moving in that direction.
So when are you going to pump up that stock exchange thing that's part of this whole platform? I mean, these other guys have these monster exchanges, and you got them all, but it's just kind of this little thing.
Well, we build them and grow them rather than overpay and then deal with it.
Well, you're looking the wrong way, dude. Over there.
Given your position, don't go too crazy on the overpaying. That might work out in the future.
You never know where those boots may end up, right? So one of the things that I'm concerned with is the impact of the financial crisis on the next generation of traders. When you hear back of people that grew up in the Depression, they had a different mindset about how they approach things. Probably the guy that has the biggest ball of string, grew up in the Depression, kind of a thing. How is this financial crisis, going to impact the next generation of traders, risk takers, and what are the exchanges kind of doing about it? What are they doing about education in order to kind of deal with the financial crisis?
I think it's actually a great opportunity for the options industry, and through the OIC, we are attacking it. And one of the things we're doing through the OIC is focusing on financial advisors, because we have a great story to tell as far as how people can use options and buy insurance on their portfolio, put on a collar, and do some things that had they been on, they could have avoided a lot of this loss. And there are a massive number of people who put all their money with an advisor and thought they were paying for this expert advice and did just as bad as everyone else or worse. And I think right now we're in a position where if you're doing it yourself and you're trying to get educated, it's a great time to learn about options. But also if you're an advisor, it's a great time to be able to talk to people about some things that they could do in their portfolio that could limit their losses and reduce their risk.
I think you're right about what happens. The effects are long term. The dramatic financial incident in the U.S. in the last 100 years was obviously the Depression, and therefore there's a tendency to want to avoid a recession, depression at all costs, and inflate out if necessary. If you look at Europe, the defining moment at the same time was hyperinflation, and they're willing to go through recessions to avoid hyperinflation because we know what hyperinflation did. If things persist for a long time and there's indeed a change in behavior and people start saving money as opposed to spending more than they have, that will generate a lot of extra capital that needs to be invested, and that's good for our business.
So I'll open it up for questions in just a second, but I want to end on kind of an upbeat note, and so my question is this: if Joe Biden is right that we shouldn't go in airplanes or buses or trains or anything,
then we're all stuck in Florida.
How are we going to get home?
We're not.
My shoes look a lot more comfortable than Ed's, so if we're walking.
Bill, this is the guy that you beat, right?
And his family won't even
go. I've seen that in New York City the other day.
How serious is this swine flu thing? How prepared are we as an industry for it? Kind of a thing. I mean, at this point, it still seems kind of minor, but who knows? I mean, if it gets as big as the media tends to blow things up, it could get...
Right, that's what this is. This is the media blowing something out of proportion again, and it's very much like we talked about short sale earlier. The media blew that out of proportion and made everybody think that all the hedge funds are out there leaning on these stocks, pushing them down to profit on them, when in fact that's wrong. The swine flu is in fact it's a concern, and it's a concern for all businesses, and everybody's paying a lot of attention to it. But I don't think it's the end. This isn't suddenly half our population's not going to be able to function, unless, of course, we stop getting on planes and
the
trains.
CME isn't to blame for it at all?
Of course they are.
We do have a responsibility to the industry. We have a responsibility to all of the people that work at our exchanges to be prepared. And it's important that while we may not believe it's going to happen and there will be a pandemic to the degree that it affects the ability for employees to come into the office and run these markets, that we be prepared for that possibility. I can only speak for the ISE, but I would assume it exists at all of these markets that we have plans in place. This is not something that we developed in the last week. It's something that exists on our books in terms of a business continuity plan and practice that we have already put into place, that we have shared with our employees so that they know what they need to do in case this escalates from a 5-level to a 6-level. And it's okay to joke about it, but it's not okay to be prepared for it, and it's something that everybody needs to take seriously.
Keep in mind, we're infinitely better off than we would have been 20 years ago when everything was on the floor. The fact that we're all trading on computer, 90% of the business is in computers, means that theoretically the industry can continue quite well. It's just a matter of making sure that everybody can access their work tools, whether they're traders or exchange people. They can continue to access the platforms and do what they want to do.
Right.
It's much better than it would have been 20 years ago.
And to Gary's point, every city, all the large institutions, all the business, all the exchanges have got pandemic plans. We've got actions in place. We've got full plans so we can keep these markets functioning. The market
that began some time ago. In fact, SIFMA has coordinated calls in recent weeks, and even this week, I believe, where there are some walkthroughs of what the various exchanges would do and working with the clearing corporation and all. Yep. So there are contingency plans in place, and we just hope that you're right. I happen to agree with you that there's too much media coverage.
Oh, God, the media, again. Do we have any questions out there from the audience at all for our panel here before we close? Oh, we do, right in the front. Mr. Sandy, yes, wait for the microphone. Wait. It's coming to you soon. Not as if you need it.
Well, back to Bill Brodsky again. Now, I want to say that I don't think anyone deserves the award more than Bill, but I was struck by the fact that his single most important paradigm-changing act was not mentioned, because Bill was the person who ordered the SIBO to multiply list Dell and therefore start the whole multiple listing world that has allowed for all of these folks to be up here. So my question to the panel is, why do we think Bill did it? A, was it an act of principle because Bill firmly believes in competition? B, he wanted to put the PHLX down. C, he wanted to stop the ISE. Now, if you believe the answer is A, do you think in your hearts that Bill really believes that indexes should be multiply listed?
Well, Sandy has been quiet in recent months. It's good to see that he's not totally gone and disappeared. And I don't know how long you're going to be in this business, Sandy, but as long as I'm here, you're not getting anywhere near those indexes.
I'll go for A and yes.
A and yes.
I might be naive.
Yeah. All right, well, I want to thank all of our panelists here and thank the box for inviting me to moderate it, and hope to have the opportunity again. Thank you, gentlemen.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.